So this is to all the investors out there sitting on the sidelines. If you're listening to this, one of two things is probably true. Either you have capital sitting in a retirement account, a savings account, investment portfolio that has not performed the way you expected, or you are an experienced investor who has been watching the real estate space, knows you need to be deploying into real assets, and has not yet found the operator you actually trust. Either way, this article was written for you. I'm not going to give you a sales pitch. I'm not going to promise out returns. I'm going to flash a I'm not going to flash a hockey stick projection at you and tell you to wire money. I'm going to do this. I'm going to lay out the data, the industry numbers, the structural shift that is happening in housing right now, and the reason why investors who position now are going to look back in 5 to 10 years and realize they got in at exactly the right moment. So let me start with the conversation I have most often. An investor tells me they have capital sitting in savings, money market, or an underperforming retirement vehicle. They know they should be doing something with it. They have been meaning to research alternatives, but they will get to it next month. Then next month becomes next quarter. Next quarter becomes next year. And the entire time, that capital is losing value. And here's the math that nobody wants to look at. Inflation has averaged between 2 and 4% annually over the past several decades. In recent years, that number has been significantly higher. Money sitting in a standard savings account earns a fraction of a percent. The difference between what your money earns and what inflation takes is called negative real return. Every single year, your capital sits in a low yield account. It is buying you less house, less land, less food, less of everything that has actual value. That is not theoretical. This is happening right now to billions of dollars sitting in American savings account and conservative retirement vehicles. The investor who deploys capital into assets, real assets, not just chasing returns, they are protecting purchasing power. And they are converting paper currency that loses value over time into physical assets that have historically appreciated, generated cash flow, and outlasted economic cycles in modern history. Okay? Doing nothing is not safe. Doing nothing is the most expensive decision an investor can make. If you want to become an investor, deploy the money that is losing value into assets. Before we talk about why Barndominium development is positioned the way it is, let's look at what the broader investment landscape actually looks like. I'm not going to quote you what Fortified Capital is projecting. I'm not going to make any forward-looking promises about what our investors will receive. What I'm going to do is share what the industry data has shown over multiple decades across major asset classes. These are not fortified numbers. These are industry averages drawn from public data, academic research, and institutional reporting. Standard savings accounts have historically returned a fraction of a percent annually. Even certificates of deposit and money market accounts in favorable rate environments rarely exceed the rate of inflation. After taxes and inflation, the real return is often negative. This is the floor. This is the baseline that every other asset class needs to be worth considering. When it comes to bonds and conservative portfolios, government and corporate bonds have historically returned in a range of 4 to 5% annually over long time horizons. After inflation and taxes, the real return is modest. Bonds preserve capital, they do not build wealth. For investors in retirement preservation mode, this can be appropriate. For investors in wealth building mode, this is insufficient. In the public stock markets, The S&P 500 has historically delivered annualized returns in the range of 7 to 10% over long-term horizons. This is the benchmark most investors compare everything else to. What this number does not show is the volatility, the 30 to 50% drawdowns during recessions, the years where investors saw half their portfolio evaporate before slowly recovering, emotional toll of watching market sentiment destroy years of compounding. Public stocks on paper, they go up, they go down, and the price is set every second by traders, algorithms, and headlines that have nothing to do with the underlying business. Publicly traded real estate investment trusts, REITs, have historically delivered returns an average of 8 to 11% annually. They offer real estate exposure with stock-like liquidity, but they carry significant stock-like volatility. And the investor in a public REIT owns a share of a fund that owns properties. They are several layers removed from the actual real estate. Private real estate and direct development is an industry category where the most sophisticated investors deploy capital. Industry data on private real estate, direct development, and value-add real estate strategies has historically shown returns in the range of 12 to 18% annually for well-maintained projects. Some categories and operators have exceeded this. Some have underperformed. The asset class as a whole has consistently been one of the strongest risk-adjusted return categories available to accredited investors. So why does capital real estate outperform the public markets? Because the investor is not paying a premium for liquidity they may not need, because the asset is not subject to daily price discovery driven by market sentiment, because skilled operators can create value through development, improvement, and operational efficiency that public market investors cannot access. And because the asset is real, you can drive it. You can drive to it. You can walk it. You can verify that it exists. Real assets win over the long run. There's a fundamental difference between a paper asset and a real asset that most investors never fully process. When you own a share of a public company, you own a claim against future earnings, a claim that exists on a ledger somewhere, a claim that is valued every second by people who have no relationship with the underlying business. When you own a piece of real estate development, you own a thing, land that physically exists, structures that physically exist, tenants or buyers who physically use those structures, cash flow generated by people paying real money into occupancy, real space. This distinction matters enormously when markets get rough. When markets correct, paper assets can lose 30 to 50% of value in weeks, sometimes in days. This has happened in 2008 and in 2020, and multiple other periods throughout modern financial history as well. The investor watches their portfolio statements and sees half their net worth evaporate. The underlying companies are still operating, the buildings are still standing, the earnings are still being generated, but the paper against those earnings has been repriced by panic. That is the nature of paper assets. They are priced by sentiment, not by reality. Real estate has historically been one of the most realist asset classes during periods of market stress. The land does not disappear. The structures do not vanish. The need for housing does not evaporate because the stock market had a bad week. Yes, real estate values fluctuate. Yes, there are periods of price correction in housing markets, but the underlying asset continues to exist, continues to be useful, and continues to generate cash flow from real demand. An investor in a private real estate development is not getting a price ticker. They're getting periodic distributions and reports on the actual performance of the actual asset. That is not a bug, that is a feature. The absence of daily price discovery is one of the reasons private real estate has historically delivered superior returns. The investor is not constantly being tested by emotional volatility. They're letting the asset do its work. Every emerging asset class follows the same curve. It starts in the innovator phase. A handful of people are doing the work. The mainstream dismisses it. Returns are highest because competition is low and the operators who get in early are capturing all the alpha. Okay. When it moves to the early adopter phase, industry validation begins. Financing opens up, awareness grows, returns are still getting strong because the asset class is becoming legitimate, but has not yet attracted the institutional capital that compresses returns. Then early majority arrives. Mainstream acceptance kicks in. The asset class becomes a category, returns moderate as competition increases. Then late majority, the institutional players show up, cap rates compress, the easy returns are gone, the asset class is now efficient, which means investors are getting the same risk-adjusted returns they could get anywhere else. Then laggards. The asset class is saturated. Returns are minimal. The opportunity window is closed. This pattern has played out in every emerging asset class in modern financial history. Self-storage, mobile home parks, short-term rentals, build-to-rent, multifamily syndications, every single one followed this exact curve. The largest fortunes in those categories were built by the investors who entered during the innovator or early adopter phase. The investors who waited for mainstream acceptance captured a fraction of that value. The innovator phase ran from roughly 2015 to 2022 for Barndominiums. During that period, the operators who were quietly building Barndominiums and providing the model where operators were operating in near total obscurity, financing was difficult. Comparable sales did not exist. The mainstream housing industry dismissed it. Now we are in the early adopter phase. Financing is widely available. Insurance data is building. Appraisal comparables are growing. Television networks are producing shows about Barndominiums. Demand is rising rapidly, but the institutional capital has not yet arrived. The big national home builders are not yet competing in Barndominium tract development at scale. The cap rates have not yet compressed. This is the window. In 3 to 5 years, the early majority phase will begin. Major home builders will enter, banks will be actively competing for the business, financing landscape will be fully mature, returns will moderate as competition increases. The investors who position now in the early adopter phase capture the disproportionate value of being in before the mass arrive. The investors who wait for the early majority phases will be getting in the same time as everyone else. They will earn reasonable returns, but they will not capture the alpha that comes from being early. So this is how Fortified Buildings is positioned to lead the revolution. And Fortified is not a fund manager that raises capital and then goes looking for an operator. Fortified is not a builder that decides to start a fund. Fortified is a vertically integrated platform that was built from the ground up to capture the full value of Barndominium developments at scale. We are the builder. Fortified Buildings is the construction company. We build the homes ourselves. We control the timeline. We control the quality. We control the cost structure. We have refined the building system through years of work in the field. When you invest in Fortified Capital, you are not handing your money to a fund that then hires a third-party builder who may or may not deliver. You are deploying capital alongside the operator who is physically building the asset. This is structurally different than virtually every other real estate syndication you will evaluate. Fortified Capital Development Fund, LLC, is the investment vehicle. We structure the deals, manage the capital, and make the investment decisions on which projects to pursue. Same leadership, same team, same alignment, The person making the investment decisions is the same person who is building the houses. The interests are aligned at every level. We operate in the Midwest where land basis is favorable, competition is lower than coastal markets, and demand for affordable, durable housing is strong and growing. We're not trying to develop in saturated, overpriced markets where every deal is a fight for thin margins. Our markets give us the cost advantages that translates into stronger project economics. Every property we develop has multiple paths to exit: retail sale to end buyers, refinance and hold as a rental, owner finance with a balloon. We never enter a deal with only one way out. This is not aggressive underwriting, it is conservative structuring. We plan for the market to do what the market does, and we position every asset to perform regardless of which direction conditions shift. We invest alongside our investors. Same deal, same risk, same outcome. Our capital is in every project we develop. When you invest with us, you are investing on the same terms we put our own money in. This is the simplest and most powerful trust signal in the entire alternative investment space. It is also one of the rarest. If you have never invested in private real estate before, I want to address this directly because it is a conversation I often have. Many of the most successful professionals I talk to have spent decades building their careers, their businesses, and their savings. They have put money into 401k accounts, IRAs, traditional brokerage account, maybe even primary residence. They have done what they were told to do. And they were never invested in private real estate, not because they couldn't, but because they did not have the means, but because nobody walked them through how it actually works. And the financial industry has done a poor job of educating high-income earners about the alternatives that have always been available to accredited investors. Here's what you need to know. Private real estate funds like Fortified Capital are available only to accredited investors. The SEC defines an accredited investor as someone who has an income of $200,000 or more, $300,000 if you're married, for the past 2 years, and with exceptions of similar income going forward, or a net worth of $1 million or more excluding primary residence. If you meet this criteria, you have access to private real estate. Self-directed retirement accounts. Many investors do not realize that they can deploy retirement capital into private real estate through a self-directed IRA or solo 401k structure. This allows you to put existing retirement funds to work in alternative assets without taking an early withdrawal. That's huge. If you have substantial retirement savings sitting in traditional vehicles that have underperformed, this is worth exploring with a qualified custodian. Investing in private real estate fund is not the same as buying a stock. It involves a conversation. It involves due diligence. It involves reviewing legal documents and understanding the structure. But it is not complicated, and it is not high pressure when you're working with the right operator. A typical first conversation with us is 15 to 30 minutes. I'll walk you through how we structure deals, ask what questions you have. We figure out together whether this is a fit. No pitch, no urgency tactics, just conversation. If this is a fit, the next step involves reviewing the private placement memorandum, completing accredited investor verification, and committing capital on terms that work for both parties. Most investors tell me afterward that the conversation alone changed how they think about deploying capital, regardless of whether they ultimately invest with us or not. The investors who got into self-storage in the 1990s built generational wealth. The asset class was dismissed by a niche real estate category at the time. Today, it is one of the most institutionalized real estate sectors with cap rates that no longer support outsized returns. The investors who got into mobile home parks in the 2000s captured similar outsized returns. The category was unsexy. The mainstream avoided it. The early operators consolidated the space and built fortunes. Today, institutional capital has compressed the opportunity significantly. The investors who got into short-term rentals in the early 2010s, when Airbnb was still a curiosity, watched their properties appreciate dramatically while generating cash flow at rates traditional rentals could not match. Today, the space is saturated, regulations are tightening, and easy money is gone. The pattern is identical every time. An emerging asset class, early operators proving the model, industry skepticism, then validation, then financing, then mainstream acceptance, then institutional capital, then compressed returns. The investors who captured the most value got in before validation. Barndominium tract development is the early adopter phase right now. The validation has happened. The financing has matured. The demand is documented, but the institutional capital has not yet arrived. This is the same window that existed for the categories above before they became institutionalized. The bottom line, if you have capital sitting still, you are not preserving it. You are losing it slowly to inflation, opportunity cost, and the relentless compounding of doing nothing. If you have retirement savings in vehicles that have underperformed, those dollars have alternatives you may not have fully explored. If you are an accredited investor who has never developed or deployed into private real estate, you have access to an asset class that has historically delivered some of the strongest risk-adjusted rate returns available. And you have it precisely because of the income and net worth you already built. Barndominium development is positioned at a moment that does not come along often. Real demand, mature financing, proven operators, institutional capital, not yet present. A structural shift in how American housing is being built. Fortified is positioned to lead that revolution. Vertically integrated, operating in the right markets, building the right product, structuring deals with multiple exit strategies, investing alongside every investor we work with. We did not wait for the industry to catch us. We helped build the industry. And now we're scaling it. With the investors who recognize what this moment actually represents, if that is you, let us have a conversation. My calendar link is below. No pitch, just a conversation between two people who take capital seriously. Disclaimer, this post is for educational and informational purposes only. This does not constitute an offer to sell or solicit an offer to buy any securities. Any such offer would only be made through a private placement memorandum.